All right, here we are. So let's see, where were we? I know, chapter 16. All right, so we'll just carry on with that. And if we finish, we'll start with 17. Oh, wait a minute. Do we have something to do? No, we're good. Okay. All right. So I believe we'd already finished our discussion about, let's see, where did we leave off? Hold on one second. Oh, okay. So yeah, the midterm has been posted. According to my notes that I wrote to myself, they should be ready by Monday night at midnight. That sounds good. And oh, I get it. Okay, so it looks like we did not quite get to real exchange rates. All right, now I see. All right, so let's start with that. So we started with PPP. I guess last week we started looking at purchasing power parity. And so we'll just quickly review what that was all about. And all right, so here we go. So we have 4 parity conditions in this chapter. And in this chapter, we're looking at long run conditions that affect exchange rates. Up to this point, we've been focusing on short run factors that determine exchange rates. Now we're focusing on the long run. And remember, in the long run, prices are flexible. So the prices can now have an effect on exchange rates in the long run. And also what we want to note here is that in the long run, the motivation for holding foreign currencies switches from holding them as an investment to holding them in order to buy foreign goods and services. Okay, so let me just throw that in here real fast. So in the short run, it is assumed that the main motivation for holding foreign currencies is to acquire foreign investments. Okay, in other words, it could be for stocks, it could be bonds, it could be foreign deposits, bank deposits, but it could also be for real assets such as property, buildings, etc. So in other words, we're assuming that in the short run, the reason why people want to hold a foreign currency is mainly to invest in a foreign country's assets. So again, that would be things like stocks and bonds and bank deposits and other assets such as property and buildings. But in the long run, we're switching our assumptions. We're assuming that in the long run, the main motivation for holding foreign currencies is to to buy foreign goods and services. As a result, factors that influence the attractiveness of a country's goods and services will affect exchange rate in the long run. So again, the factors are very different in the long run because we're assuming that people are mainly interested in buying a foreign country's goods and services rather than investing in that country. So along those lines, we have these parity conditions, which are long-term explanations as to the relationships between exchange rates and these different factors. So for example, we have two versions of purchasing power parity, and we have two versions of the Fisher effect. We have the domestic version and we have the international version. So quickly, since I know we've already done this, the purchasing power parity doctrine tells us that the exchange rate between two countries will be determined ultimately by the price levels in those two countries. In other words, how expensive are goods in those two countries. And in general, the more expensive a country's goods, let me just throw that in here too. The more expensive are a country's goods and services, the weaker should be its currency. That is basically what this is all about. Okay, so countries with high inflation rates should also have weak currencies. Okay. So now PPP, as we've seen, is based on the law of one price, which basically says that a good should sell for the same price in all markets. And if we're comparing two different countries, then the good should sell for the same price after adjusting for the exchange rate. So the quick example we had here was that if gold is selling for $400 an ounce in the US and the exchange rate is $2 per pound between the dollar and the pound, that implies that we should expect to see gold selling in the United Kingdom for 400 pounds per ounce. If not, then arbitrage opportunities will arise. So how and why is this happening? Well, if the price of gold is less than 400 pounds per ounce in the UK, profits could be earned by buying gold in the UK. I'll note in parentheses here where it is underpriced, and then simultaneously selling gold in the US where it is overpriced. That's always the underlying logic behind arbitrage. You're buying something that's underpriced, and you're selling something that's underpriced. Sorry, I said that backwards. You're buying something that's underpriced, and you're selling something that's overpriced. That's how you make your money with an arbitrage. So here, if the gold is below 400 pounds an ounce in the UK, that means it's too cheap in the UK. We buy it there. And then that means it's too expensive in the United States, and that's where we want to sell it. Now, what the effect of this would be, though, is that if people are buying gold in the United Kingdom, that should drive up the price there. And if people are selling gold in the United States, it should be falling in price there. And the net effect of this is that pretty quickly, the prices should be equal in the two countries. And then when that happens, the law of one price will then have been reestablished. But not before people were able to make arbitrage profits. Now, on at the other extreme, if the price in the UK is more than 400 pounds an ounce, we'll buy gold in the US, where again, this is now where it is underpriced. And then we'll sell it in the UK, where it is overpriced. Okay, so remember, it's the same logic every single time. Buy where it's too cheap, sell where it's too expensive. Okay, and the difference goes into your pocket, of course. That's the whole premise of this. You're making money by taking advantage of a good that is mispriced in two different markets. So, of course, as this continues to happen, because we're selling gold in the UK, that means the price is dropping. Because we're buying gold in the United States, the price is going up. And that means that at some point, the prices will be equal and the law of one price will be reestablished. And that, of course, means there's no longer any arbitrage opportunities. So it takes care of itself. And arbitrage can't last for very long. It only lasts until somebody actually notices it. Okay, once they do, they start taking steps to take advantage of it, and that forces the prices back together again. All right, now this type of procedure is called goods arbitrage because we're dealing with a physical good as opposed to a financial asset. Now, here's something we need to also note here. One drawback to goods arbitrage is that since it involves physical commodities or physical goods, let's say, the costs involved can be fairly high. In our example of goods arbitrage with gold, there is a cost associated with shipping gold between the US and the UK. So what that does is it puts a limit on how much we can earn from our goods arbitrage. So in other words, just as an example, suppose that it costs $10 per ounce to ship gold between the US and the UK. This means that in order to earn arbitrage profits, when gold is mispriced, the mispricing must be at least $10 per ounce. Otherwise, the transactions costs would swallow up all the arbitrage profits. Okay. So it means that if the prices are not different by at least $10, then there's no point in engaging in this type of arbitrage because it's expensive. It's $10. It could be more than that actually, but if it costs $10 to take care of this, then that means the differential in the price between the two countries needs to be a minimum of $10 in order to make this worth our while. With financial securities, the transactions costs are likely to be much lower or be a much lower percentage of the values of these securities, so that arbitrage is more likely to take place when there are pricing discrepancies. So that's something we have to take into account with goods arbitrage. It's not quite as simple as it sounds because there are costs involved. Whereas with financial securities, it's a much simpler process. Now, with all that being said, PPP is based on the assumption that the law of one price holds for all goods and services, so that it is measured in terms of national price levels, by which we mean, for example, the CPI in the United States and the RPI in the UK. So that would be our other example. As another example, the price level in the UK can be measured with the RPI, which is, of course, means retail price index. Okay, now, with all that being said, the actual exchange rate, the equation for the exchange rate with PPP looks like this, where E is the exchange rate in terms of units of the domestic currency per unit of the foreign currency, which could mean, for example, dollars per pound. And the P is the domestic price level, and the P star is the foreign price level. So this relationship implies that E could be written as P over P star. And so this shows that if US prices are higher than UK prices, then E will increase And of course, that simply means the dollar will depreciate. And that's exactly what you would expect, especially in a long time frame when we're assuming that the strength of these currencies is determined by how easily it is to buy those goods and services. So the more expensive our prices are, the more likely it is that foreigners will fail to buy American products and buy their own instead, and that will cause the dollar to get weaker. All right. Now, I think we've already talked about the Big Mac index. Did we? Let's see. I hope, if not, well, let's check it out. Let me take a look and see. I've got a list of the videos that we've been watching. Let me just confirm. Yeah, we saw it. That's fine then. All right, we won't need to go over that again. But just remember that the Big Mac Index is an attempt to show whether or not purchasing power parity holds in practice by comparing the prices of Big Macs in the United States and other countries. And we saw that for the most part, they do not. In fact, the discrepancies can be quite significant. So, but the Big Mac, now keep in mind, the Big Mac is clearly what we mean by non-traded good because has a very low price to start with, and shipping it back and forth between different countries would be very expensive. And then on top of that, it certainly is perishable. So you wouldn't expect PPP to hold with the Big Mac, but it might still be a little surprising how far off these exchange rates are compared to what PPP suggests. In fact, if you want to see the latest value of this index, you can look here at the Economist magazine, and you'll see that this is the latest version. And so they give us a little, oh, wait a minute, where's that chart? There it is, there it is. So there's our chart. Now, if you notice, if PPP really held, these under or overvalued numbers would all be zeros. But they're not even close. Look at that. Almost every single currency in the world is significantly undervalued according to PPP. So they're giving us as an example right here the pound and the dollar. So they're telling us here that a Big Mac, let me just throw this in here somewhere. As an example, let's throw this in here. We can see what they're referring to here. In 2021, they're telling us that a Big Mac costs 3.29 pounds in England, of course, or the UK, and 5.66 in the US. Now, the actual exchange rate, well, let's start with the implied exchange rate. According to PPP is, so here's what you would have. 5.66 per Big Mac divided by per Mac, 3.29. Let's insert the pound symbol here. $3.29 per Mac. So what you end up with here is that ratio of 5.66 over 3.29 is 1.72, approximately 1.72 dollars per pound, where the max drop out. Okay, that's what it should be according to PPP. But they make the point in the article that the actual exchange rate at the time this was published 0.74, that's pounds per dollar. That's equal to approximately $1.35 per pound. So what happened? So according to PPP, or the PPP doctrine, I guess we should say, the actual exchange rate is too low. In other words, the price of the pound is too low to be consistent with PPP. So that means that we say that the pound is undervalued by, and then you can come up with the approximate percentage difference as this percentage difference between the two about 27%, roughly. So according to the PPP doctrine, the pound is undervalued by about 27%. Okay. Well, that tells us that either the exchange rates in the real world are inaccurate or else PPP fails to hold. And I think we know which one it is. And again, the logic here is that because this is a non-traded good, in other words, it's too cheap, the price is too low for us to make a profit by shipping it overseas, then we would certainly expect that Big Macs are not consistent with the law of one price. It might work for gold, but certainly not for the Big Mac. Now, when the economists brought this thing out in the 80s, I think that they believed it was sort of not exactly a joke, but they never really expected it to be taken too seriously. And yet here it is, 40 some odd years later, and they're still publishing it, and people really do like to read about it. It really is a very interesting idea. And so ever since then, The Economist has published this index every single year. Okay, but you can see virtually all the world's currencies are considered to be undervalued according to this PPP doctrine. Almost none of them are overvalued. You can see them up here on this chart. And some of them are as much as 61.9% undervalued. So that's a significant difference. Very significant. Okay. Anyway, so non-traded goods and services, as we alluded to a few times, these are goods that are either too inexpensive or perishable for the law of one price to hold, okay? Because it would be too expensive to try to earn arbitrage profits when this is true. So certainly services cannot typically be traded between countries. So both non-traded goods and services, with those two, we'd expect to see that the law of one price fails to hold. Now, if the law of one price doesn't hold for most goods, which it doesn't apparently, then the PPP doctrine itself is obviously fatally flawed, and we would not expect it to hold in practice. Now, trade barriers are part of the reason why this is happening, because sometimes the reason why prices are different is not because the different markets have different ideas about what the currency is worth or what the product is worth, because sometimes governments interfere. Mainly what they do is they impose tariffs or quotas on imported goods. And the point of that is to increase their expense to domestic consumers. So it may very well be that the reason why the Big Mac's costs are so much different in different countries is that there may actually be trade barriers imposed against McDonald's that make it harder for McDonald's to do business in those countries. And that means more expensive than they otherwise would be. So this is part of the reason why the law of one price doesn't always hold, because of trade restrictions. It's not just the non-traded goods and services, it's also because of these trade barriers. All right, so now with all that being said, There's a different version, I should say, called relative PPP, which is somewhat more realistic than absolute PPP. Because here, what they're telling us is that changes in the exchange rate should be determined by changes in price levels, or in other words, inflation rates. So what does that mean? Well, it implies that high inflation countries should certainly have the weakest currencies. And there's a lot of evidence to suggest that that's the case. There's no reason why people will buy goods in a country where prices keep rising. So, but the formal definition of this relative PPP condition is right here. So we have the percentage change in the exchange rate is equal to the percentage change in the two price levels. And these individually are themselves inflation rates. So this is the domestic inflation rate. This is the foreign inflation rate. And so this equation is basically telling us that if the domestic inflation exceeds foreign inflation, then that percentage E has to be positive. And that means that the domestic currency will get weaker. Okay, so domestic inflation exceeding foreign inflation implies a higher percentage increase for this E, which implies in turn the domestic currency depreciates. Of course, if the percentage, if it's the other way around, in other words, if U.S. or domestic inflation is lower, then obviously all this works in reverse. Okay, that's what this is telling us. And so there's a lot of empirical support for this, far more than, of course, for just absolute or just plain PPP, where it doesn't seem to work very well. But here, in fact, we might actually be able to find on the internet a chart that shows how well this really works. Let's see if we can find something like that. How well does relative PPP work in practice? All right. Well, this is Investopedia. I hope we can find a chart. Maybe not. Ooh. All right. Maybe not. Let's see if I can ask for a chart. Oh, what do we have here? Oh, no, I don't think that's what I want. That's regular PPP. Ooh. All right. Well, I guess, we don't want to waste all night looking for it. Maybe not. Okay. All right. So maybe not. All right. We'll look for it later on. Okay. But anyway, so let's look at a quick example. The spot exchange rate between the dollar and the pound is $2. The US inflation rate is 2%. The UK inflation rate is 4%. And since the US inflation rate is lower, that implies that the dollar should get stronger. But by how much? All right. So according to relative PPP, the change in the exchange rate over the coming year, holding everything else constant, should be, all right. So we've got, US inflation rate here. This is UK inflation. And so the difference is minus 2%. So the exchange rate should drop by 2%, which means the dollar should appreciate by 2% over the coming year. And that's again assuming nothing else changes. All right, and so if we start out as a $2 exchange rate, by lowering that by 2% rather, that would bring it down to $1.96 per pound, which is indeed a strengthening of the dollar by 2%. Okay, so what other conditions do we have that help explain currencies in the long run? Well, we have the Fisher effect, which basically itself is a domestic condition only, but it can be extended to the international sector. So the Fisher effect simply tells us that the nominal rate of interest, which means not adjusted for inflation, can be written in the following way. So the nominal rate equals the real rate, which if you recall, is adjusted for inflation. And here we have what we'll call the expected inflation rate. Okay, this was the Irving Fisher's idea. Now, Irving Fisher wrote this at the beginning of the 20th century, and it's still used to this day, which shows you how important it proved to be. And so here's our biographical sketch of Irving Fisher. You can see he was a scholar, and he was also an entrepreneur. He got the first ever PhD in economics at Yale. He had taught there for a while. He wrote the book Theory of Interest, which contains his great idea here, the Fisher effect. He thought it would make more sense to have a consumption or sales tax instead of an income tax. He created the idea of price indices, and he invented the Rolodex, which made him apparently a great deal of money. Okay, and if you haven't seen a Rolodex, it's this little device that helps you keep track of index cards, which are designed to help you keep track of people's information, specifically their names and addresses. So if you were a salesman in the past, you would have used one of these to keep track of all your customers. You may have seen one of these before, and they still make them, as you can see. And if you have all these little business cards in there, all you have to do is flip through and find what you're looking for, and it's right at your fingertips. So before computers came along, this was the best way for people to keep track of important information. So Fisher invented that, and of course the royalties made him very wealthy. So he was both an academic and a businessman at the same time, which is very unusual. Now, the Fisher effect can be extended to the international sector by simply noting that if we have two countries with two different nominal interest rates, we're going to make a very strong assumption. This effect assumes that all countries have the same real rate of interest okay, and that means these two numbers are the same. So basically, if you see what we've got here, we've got the Fisher effect for two different countries, country one and country two. So what that means then is if these are the same, the only way that the nominal rate of one country can be greater than for the other is if the inflation rate in the first country exceeds the inflation rate in the second country. So that means in this theory, higher nominal rates imply higher inflation rates. And so what this implies in turn is that when one country has a higher nominal rate than another country, okay, let's write this in here. If one country has a higher nominal interest rate than another country, this can only mean that the first country has a higher inflation rate and should therefore have a weaker currency. Now, what's ironic about that is that this is exactly the reverse of what we saw in our discussion about the asset market model. So, because back then, the asset market model, which if you recall, looks like this. And that in turn indicates that the equilibrium exchange rate equals EE over 1 plus our dollar sign, meaning the US dollar rate minus the UK rate. So what this means is that if US rate goes up, E goes down, which implies a stronger dollar. So in the asset market model, we're assuming that higher nominal rates of interest actually mean the currency is going to get stronger. Because remember, in the short run, two things are different than in the long run. Number one, people are assumed to be looking for the highest rate of return. And number two, prices are assumed to be fixed. So there can't be any inflation in the short run for investors to worry about. So so let me just throw that in here too. In the short run, investors are assumed to be seeking the highest real rate of return. Okay, but since prices are assumed to be fixed, if a country's nominal rate rises, this implies that its real rate also rises and its currency becomes more attractive to investors, leading the currency to appreciate. But in the long run, prices are flexible. So we're assuming here the other way around. We're saying that higher nominal rates must be a sign of higher inflation rates, which means that our currency will get weaker. So the two are exactly the opposite in that respect. So here's how it's written. Now you can see it's very much like what we had with relative PPP. So this way, this implies that if R rises, the percentage change goes up so that the domestic currency depreciates. All right, so that's what this theory is telling us. Now, whether it's true or not is a very open question. I mean, economists have been studying these for quite a while. But again, there seems to be more support for this than there would be for absolute PPP. All right. So here's a good example. So in the long run, according to this effect, if the spot exchange rate is $2 per pound, while the US rate is 5% and the UK rate is 7%, according to the Fisher effect, the dollar should actually get stronger because our interest rates are lower. And you can see by plugging these numbers, the US rate you've got 5% minus 7%. That implies a stronger dollar. So if we started at $2, just like the earlier example, that means the dollar should appreciate to $1.96 from $2. Now, just like all of these conditions, none of these four are actually arbitrage relationships. That means that, okay, I'll just add that at the bottom here. None of these parity conditions are arbitrage relationships. In other words, if they are violated, it is not possible to earn arbitrage profits as a result. Instead, these are considered to be equilibrium relationships, which means that they are expected to hold in the long run. If they are violated, they will return to these relationships eventually, I guess. So they won't, it won't last forever. If it's not happening, if one of these is being violated, then gradually market conditions will change until these conditions hold, or at least that's what we're assuming. All right, now real exchange rates. This is an interesting idea. You know that in economics, whenever you see the word real, it means that we're looking at a variable that's been adjusted for inflation. But here we're looking at an exchange rate. And so unlike other types of real variables like real GDP, for example, here, in order to create a real exchange rate, we have to adjust the nominal exchange rate for the price levels in two countries, domestic and foreign. All right, that is one unique feature of real exchange rates. All right, now, the real exchange rate reflects the cost of one country's goods and services in terms of the other countries. It is a measure of the competitiveness of a country's goods and services in international markets. Now, this distinguishes it from the nominal exchange rate, which reflects how much of one currency we can use to buy the other one. This one is expressed in terms of goods and services. Specifically, just as an example, for example, the dollar pound exchange rate reflects how many baskets of US goods. And of course, in parentheses, I'll note here that these are the baskets used to compute the CPI it takes to buy one basket of UK goods. And that means this is the basket that is used to compute the RPI, the retail price index. So in other words, imagine you've got the two baskets, the US basket, the UK basket. The real exchange rate is simply the number of US baskets that it would take to buy one UK basket. There's no currencies involved. So that's why we call it a real exchange rate, because it's in terms of goods instead of currencies. Okay, so in other words, for this reason, the real exchange rate refers to goods rather than currencies. Okay, so here's how it's defined. Now we're going to use the letter Q to represent the real exchange rate, and you can see it's closely related to PPP. Of course it is. It's a little bit more complicated, but the bottom line here is that the Q is the real exchange rate. So think of this as the ratio of domestic baskets per foreign basket. This is the nominal exchange rate. And that would mean a domestic currency per foreign currency. And then this is the foreign price level. And this is, of course, the domestic price level. That's how we calculate it. So in a sense, what's actually happening is you're taking the nominal exchange rate as your starting point, and then you're stripping out the impact of both the domestic and foreign price levels, so that what's left is a number that represents how many domestic baskets it takes to buy a single foreign basket. So it's baskets rather than currencies. All right, now, in fact, you know what, actually what's interesting is that we could probably find somewhere out there, I'm not sure, they've got real, maybe this is it. Most likely, this is not exactly the same. I think what this is it's the same idea. It's the real exchange rate, but I think it's defined in terms of not a single foreign currency, but a collection of foreign currencies, so that it's meant to reflect in general how strong the dollar is getting against these other currencies in real terms. So we'd have to look up the exact definition of this measure, but it looks to me like this is being demonstrated or reflected as not a single foreign currency, but a group of them. In fact, it's probably down here somewhere. Oh, maybe not. Well, if we dig deeply enough, we'll be able to figure out how they calculated this. But anyway, enough. That's enough. We can find it. We can do, this is fine. We'll just focus on the dollar and the pound. So here, the Q is the real exchange rate in terms of US baskets per foreign basket. E is the nominal exchange rate, dollars per pound. P would be the CPI or US price level. And P star must be the foreign or British price level, which is the RPI. All right, so let's do a numerical example. The US basket, let's say it costs $100. UK basket costs 80 pounds. The spot or nominal exchange rate is $2 per pound. Q therefore equals, so remember, it's Q equals E P star over P. So this is E, this is P star, the foreign price level, and this is the domestic price level, P. If you look at these units, you notice the pounds cancel each other out, and the dollars will as well. All the currencies will drop out of this calculation. So in the numerator, we have $160 required to buy a single UK basket. In the denominator, we simply have $100 for a US basket. So if we take this ratio, these drop out, as do these, and we wind up with a real exchange rate of 1.6. 1.6 US baskets are required to buy a single UK basket. Interesting. It's not, there's no dollars, there's no pounds, it's US baskets per UK basket. All right, now what's interesting here too is that we can have, just like with the nominal exchange rate, we can see that there can be an appreciation or depreciation of the real exchange rate. That can happen too. All right, so why don't we do some examples and see how this works? So keep in mind here, these refer now to changes in the competitiveness of a country's goods and services. That's all we're focused on in the long run, by assumption. All right, here we go. So now we're going to make some changes. Originally, the US basket sold for 100. Everything else is staying the same here. Okay. So that, oh boy. That being the case, let's see what the new real exchange rate is. So remember before, Q is equal to 1.6. Let's see what happens as a result. So we throw in the numbers like before. Oh, while we're at it, let's remind ourselves that Q equals E P star over P. And what just happened here is that the domestic price level went up. So if P rises, we have a larger number in the denominator, Q drops. All right, so let's see how far it goes. So we go through the numbers and oh, sorry, I got it backwards. No, the price of the US basket went down, my fault. Wait a minute, I was gonna say what happened here. So P went down. And since that's in the denominator, it means that Q had to go up. And so that's exactly what happened. So it went from 1.6 to 2. Now Americans have to pay 2 UK baskets or US baskets to buy 1 US basket. Okay, now Q increased from 1.6 to 2. And we call this a real depreciation of the dollar, because it now takes more US baskets to buy 1 UK basket. And now this is perfectly consistent with what we had with the nominal exchange rate. Remember, like if we went from, let's say, $1.50 per pound to $1.75, that would have been referred to as a depreciation because it takes more dollars to buy a pound. So the same exact thing is happening here. An increase refers to what we will call from now on a real depreciation. Now, what does that say about our trade balance? Okay, well, think about this. US goods are cheaper to the UK consumers. They can now trade one of their baskets for two of ours. At the same time, though, UK goods are more expensive to American consumers. So the net effect of this is that US exports will increase. US imports will decrease. And the US trade balance will improve. And I'll note in parentheses here, just like a nominal depreciation of the dollar. So remember, with a nominal depreciation, the US goods are now cheaper to foreigners. Foreign goods are more expensive to Americans. The net effect will be that we'll buy less foreign products and foreigners will buy more American products. And so because of that, our trade balance will improve. So in that way, they're perfectly consistent with each other. A real depreciation and a nominal depreciation will make our goods more attractive overseas, and that will improve our trade balance. Now, on the other hand, what if we do the opposite? So remember, originally, when the US basket cost $100, the real exchange rate was 1.6. Now we're letting this go up to $160. All right. So if you look at this formula again, Q equals E P star over P. This time P rises, Q falls, and this refers to a real appreciation. Just like with nominal exchange rates, a reduction in the exchange rate means a stronger dollar. So let's take a look. Let's do the calculations and figure out what the new value of Q is. So I plug in all the numbers, and just as we expected, we end up with a lower Q. Q now equals 1, and it only takes one US basket to buy one UK basket. That means that suddenly American goods are more expensive in foreign countries and vice versa. So therefore, US goods are less competitive in the real world, in US markets and UK markets. So the dollar is now said to have experienced a real appreciation. And so because of this, the net result will be fewer US exports, more US imports, and a worsening trade balance. And that's exactly what we would have expected. So when we had a nominal appreciation, we had a worsening trade balance. And the same thing is happening here. All right, so let's take a look here. So again, just to summarize this, if we have a higher Q, then the dollars experience a real depreciation, which means our goods are more competitive in world markets and our trade balance will benefit. If Q falls, the dollar has experienced a real appreciation. US goods are less competitive in world markets. And the result is that our trade balance will worsen. Okay, now there's three things that can cause the dollar to depreciate in real terms. And again, let's write out this formula so we can see why. So algebraically, remember, a depreciation means Q increases. So this can happen if either E goes up, P star goes up, or P goes down. Okay, and that of course means a nominal depreciation of the dollar, an increase in the price of British goods, or a decrease in the price of US goods. All right, well, obviously, if the dollar can depreciate in real terms, it can certainly appreciate. That would be the opposite case. This is the case where Q goes down. And again, based on this formula, this means that E must go down, P star must go down, or P must go up. All right, so that's a nominal appreciation of the dollar, a decrease in the price of UK goods, and an increase in the price of US goods. Any one of those, or any combination of those, will lead to a real appreciation and a worsening trade balance. All right, now one last detail here, PPP and the real exchange rate. Here's an interesting result. If you look at this formula very carefully, that is our definition of a real exchange rate. The PPP condition was this. If I substitute this definition of E into this equation, I'll get Q equals P over P star times P star over P, or Q equals 1. So that's an interesting result. If absolute PPP holds, the real exchange rate equals 1, meaning that one basket of domestic goods trades for one basket of foreign goods. So in empirical tests of whether or not PPP holds, what's often done is they calculate Q and see if it's equal to 1. If it's not, that indicates that PPP does not hold. If Q is very close to 1, that indicates that maybe PPP does hold. So the way you find out if it holds is to basically figure out whether or not Q is equal to 1. All right. So all of that was chapter 16. And you can see the math isn't quite so intensive here, but these concepts are still kind of tricky. All right. There's a lot going on here. But again, just keep in mind, all these results are assumed to hold in the long run when prices are flexible. Now, 17 is going to show how the real exchange rate impacts on real GNP. Now, what we need to do here in order to go through this is we want to review what we mean by GNP. GNP, remember, only refers to the goods and services produced by the citizens of a country, which means that it will include not only net exports through the current account balance, but also these net income receipts. All right, so remember, net income means, let's just quickly review this. Net income receipts refer to the flow of wages, interest, profits, rent, etc., between two countries. A country's net income equals income from foreign countries minus income paid to foreigners. This net income can be positive or negative, so that GNP can be greater than, less than, or equal to GNP. Okay, so the current account balance is net exports plus net income receipts. All of this adds up to GNP. Now, how does this, or how do real exchange rates affect any of this? Well, we're going to basically take the four components and break them down a little further. We're going to assume that consumer spending is an increased function of what we will call disposable income. And you notice there's a little plus here to remind us that if YD goes up, C goes up. If YD goes down, C goes down. In other words, this means that C and YD move in the same direction. And that makes perfect sense, because obviously the more wealth we have, the more we want to spend. Okay, so YD, like I said, is equal to disposable income, but we define it formally as real GNP minus taxes. So we'll claim here, without any controversy, I think, that disposable income can increase when either real GNP rises or taxes are decreased. Now, both of those in turn then will lead to an increase, in consumption spending, so that GNP rises. All right, so in other words, either if the economy grows or else the taxes are cut, consumer spending increases, and that in turn will increase GNP. But what does that have to do with the current account balance? All right, well, let's see. Now, first of all, let's go back and revisit this. Yes, just one more time. C is a function of disposable income. More disposable income leads to higher consumption spending. That stimulates the economy. The current account balance is assumed to be a function of two different things. First, once again, disposable income, and secondly, the real exchange rate. Okay, so we're going to assume that both of these influence the current account balance. How does this affect the current account, though? Well, let's think about it. What about YD? If disposable income goes up, we know that people want to buy more of all goods and services, including imports. So when YD goes up, imports go up. There is no change in exports. Which means that the current account balance worsens. Okay. So the fact that we have more money to spend means we're buying more imports without any necessary increase in exports. So of course it means that our current account balance worsens. So it sounds paradoxical, but more income is triggering a worsening of the current account balance. Okay, now, and of course, if our YD goes down, then that means that our imports fall. And with no change in exports, so therefore the current account balance improves. All right, now, what about the current account balance itself? Well, I mean, I think it should be pretty clear that because this, even though it's a real exchange rate, we've seen already that when Q rises, this is a weaker dollar in real terms, which means the current account balance should go up. When Q drops, we have a stronger dollar, which means simply that the current account balance falls. It gets worse. And you can see why here. A rising value Q stimulates exports, which means it discourages imports, and again, current account balance falls. All right, higher Q, lower CA. A falling value of Q discourages exports, which stimulates imports. So we have a lower Q, imports go up, and the current account balance worsens. Oh wait, I'm sorry. I got this one. I wrote this one incorrectly, didn't I? Yes. This one should say upper arrow. And then finally, yes, that's right. So in other words, you notice these are going in the same direction. Whereas over here with YD, it was the other way around. Okay, so to summarize, when YD and CA move in opposite directions, and then YD and Q and CA move in the same direction. So therefore, the notation that we'll adopt here will look like this. CA, now you notice how I'm writing this in functional notation. This means that YD and Ca, as we just saw, move in opposite directions. And this plus here means that Q and Ca move in the same direction. Wow, that was a little bit more complicated. Okay, so the other components of G and P are assumed to be independent of the real exchange rate. Okay, so in other words, remember that G and P equals C plus I plus G plus Ca. We've already seen that C is a positive function of YD. We have Ca down here. I and G are assumed in this example we're looking at to be independent of both, of YD and Q. Well, so this is the result. And so finally, we bring everything together, and this is now our new formal definition for GNP. Pretty cool, huh? And what's in here, which wasn't there before, is this functional notation, which shows us not only what these components are, but what factors determine them. Where these two are fixed. Now, we're going to use this setup to create a new set of curves, if you can believe it. We've had plenty of curves up to this point. Now we need some more. And what we're ultimately going to do with these is analyze both monetary and fiscal policy and how they affect the exchange rate and the overall economy. So that's where this is heading. We're going to derive a set of new curves. And you'll see that they're kind of interesting. They're also unique to this book. I've never seen another book with these curves before, but we're going to see how they're very easy to use to analyze both monetary and fiscal policy. And that's the whole point of this. So why don't we do this? Since it's getting kind of late here, why don't we stop and have our break right now before we introduce these two curves, and then we'll see how they work and how they help us understand the impact of both monetary and fiscal policy. Okay, so let's knock it off for a bit, and when we get back, we'll introduce our new curves, and we'll have some fun with them. All right. All right, here we go. So, all right, so the curves, yes. So basically, we have our definition of the real exchange rate. Now, we're going to start by assuming once again that we're back in the short run. So prices are fixed. So what that means then is that if these two prices are fixed, that means that if E increases, Q will increase N by the same amount. If E decreases, Q will also decrease by the same amount because they're only different by a constant now. So therefore, since Y is positively related to Q, it is also positively related to E. In other words, remember we saw before that when Q rises, let's see, CA rises as well, and Y rises. So the curve that we're going to look at is, and here it is. Now, I do not know what DD stands for. The authors of this book created this curve, and they did not bother to tell us what it stands for. We don't know what it means. But what we do know is that it is meant to represent the relationship between the nominal exchange rate and real GNP. So the authors of the book refer to this as the goods market. And basically the logic is that as E rises, net exports rise, the current account balance rises, and GNP rises. And that's why it has a positive slope. So in other words, as the dollar gets weaker, remember E going up means we have a weaker dollar, which implies more exports, fewer imports. And therefore GDP and GNP both go up. So that's what we're seeing along here. We're tracing along all the different combinations of E and Y, which are in equilibrium. And the authors choose to call it the goods market because it refers to actual goods and services that we're buying from foreigners and selling to foreigners, as opposed to financial assets, which we'll see in the next curve. Here, we're focused only on goods and services. So as far as that's concerned, there's a direct connection between E and Y in the sense that a higher E, again, means weaker dollar, more net exports, higher or better trade balance, and therefore a higher GNP. All right. So what other curve have they cooked up for us? Well, just like any other set of curves, they have to cross somewhere in order to establish an equilibrium. So there's going to be a companion curve for this that we will be able to combine in order to determine the equilibrium exchange rate. That's the purpose of this model, but what they're doing here is creating a series of curves that will enable us to easily analyze both monetary and fiscal policy and how they impact simultaneously the exchange rate and the size of the economy. Now, of course, like any other curve, if any factor other than E changes, this entire curve will shift. Okay, so this is constant. As long as E is the only thing that changes, the position of the curve will never change. Instead, changes in E lead to movement along this curve. All right, it can go up, it can go down, as the case may be, but once as E changes, we move along the curve, Any other factor causes the entire curve to shift. So how does that work? Well, the following factors will cause real GNP to rise with the same level of exchange rates, meaning that the entire DD curve has to shift to the right. All right, what could they be? Well, first, if there's a cut in taxes, why does that help increase GNP? Because if taxes go down, then Y minus T goes up. In other words, disposable income will increase, and therefore output will rise. Because, well, actually, what I should say here is that consumption rises, and so therefore GNP rises. Now, if investment spending goes up, the same thing is true. If there's an increase in government purchases, the same thing is true. There will be more output for every level of the exchange rate. More output at every level of E. What else? Is there anything else? Well, no, but what we're going to do now is note that these two terms have something in common with each other. And so if you recall, or if not, we'll introduce it now, any combination of an increase in government purchases or reduction in taxes is an example of what we mean by expansionary fiscal policy. And the word expansionary means it's designed to increase GNP. That's the point of it. Now, who is in control of this? Unlike monetary policy, which is under the control of the Fed, G and T are determined by Congress and the president. So unlike monetary policy, again, which is controlled by the Fed, G and T are jointly determined by Congress and the president through the budget making process. So expansionary means G goes up or taxes go down or some combination of both. So if you noticed in this box here, these are meant to be the factors that cause real and GNP to rise, two of which consist different components of expansionary fiscal policy. So that means, and by the way, any of these factors then will cause an increase in GNP. The DD curve shifts to the right. All right, let me just pencil that in here. So the factors that I've just discussed, all of these have the impact of increasing this DD curve or shifting it to the right. And you can tell because it means that no matter what E is, let's say E is right here at E1. On the original curve, the GNP that results is right here. On the new curve, it's over here further to the right. So all of these factors have the effect of increasing GDP at every level of E. No matter where we were before, we have more GNP as a result. Now, obviously, all this works in reverse as well if we reverse the direction of all of these factors. So now we're looking at cases where the entire curve shifts to the left, which is exactly what we don't like to see. Because now, look at this. Whatever E1 or E is, we suddenly have less output as a result. Okay, so these all cause the economy to slow down. And what do they include? Well, just the reverse of what we had earlier: higher taxes, less government spending, and finally, less C and less I. So in other words, T going up or G going down represent what we call contractionary fiscal policy. And both of those are designed to slow down the economy. So it stands to reason that this curve will shift to the left. That's the goal. The goal is to reduce output because we want to reduce the inflation rate. But any one of these will have the same effect. They will cause that curve to shift to the left. Now, you would say, well, why would we want to do this? Yes, the only reason for doing this is to slow down the economy to prevent a surge of inflation. Now, both of these, as I think you can guess, as I mentioned, a cut in government spending or an increase in taxes are collectively known as contractionary fiscal policy. Okay, so that's our DD curve. Now, the next one that will follow is a little bit more involved. This is what we're going to call equilibrium in the asset markets. In other words, instead of real goods and services, as we have in the DD curve, instead, we're now looking at financial assets. All right. So the DD curve represents equilibrium in the so-called goods market. And here we're looking at equilibrium in the asset market, by which we mean financial assets. That includes money and bonds and currencies and all the rest. And so here we're going to define equilibrium in the asset market as the situation where both the foreign exchange market and the money market are both in equilibrium. Now, this requires a graph that we've already seen many times before. Specifically, you might recall two old friends of ours. We have, all right, this one. This is the money market, as we call it. And this one all right, this is the foreign exchange market. And right here at these 2 points, we'll call them point one, both markets are simultaneously in equilibrium. Although if you recall, it's not easy to see it this way. So what we did was we took the step of combining them onto a single graph, which I'll quickly sketch out for you. And so you'll recall that we put the foreign exchange market on the top and the money market on the bottom. Okay, so here we go. So basically, we're jointly determined both E and R were determined jointly in this diagram set up here. In other words, the combination of the money market down here and the FX market up here jointly determines two variables, E and R. So these are now equilibrium values of both the exchange rate and the interest rate. The interest rate is determined in the US money market. The foreign exchange or equilibrium exchange rate is determined by the interaction between the US return and the foreign return. So this point 1 could be thought of as a single point on this new curve that we're about to develop. So let's remind ourselves, this is the model that we've been using to determine equilibrium in the foreign exchange market. And of course, this is the equilibrium condition in the money market. The real demand for money equals the real supply of money. So there's another curve, the AA curve, and again, I have no idea what that stands for, shows all the combinations of GNP and the nominal exchange rate, which are consistent with what we call now asset market equilibrium. So how does that work? So we start out with a joint equilibrium position. So this is it. And you can see that we define, we'll call this point 1. We now know both the rate of interest in the US and the exchange rate. What happens if real GNP rises? Okay, that means we move it in this direction. Okay, real GNP rises. And now at our new equilibrium position, you can see as a result, US rates have gone up because there's a greater demand for money with no change in the supply. So let's call this R$1, this is R$2. Now we've got a new equilibrium exchange rate, which is lower than the previous one, as well as a new equilibrium interest rate. So therefore, what we notice is that when Y goes up in this market, E goes down. And of course, when Y goes down, E goes up. So in this situation, Y and E go in opposite directions, the opposite of what we had back here. All right, so here, as Y goes up, as we've seen right here, E goes up, Y goes up, and vice versa. Now it's the other way around. So therefore, this curve will have the opposite slope. And so you can see again, this is what's going on. Higher y means lower e. And as a result, we end up with this. Okay, so this is our new curve AA. And you can see if we started here, if y goes up, e goes down, and vice versa. So this represents joint equilibrium. In the money market and foreign exchange market. And you can see as E changes, we move up and down the same curve. Except they're going in opposite directions. If anything else changes, the entire curve shifts either to the right or to the left, as you would expect. The question is how? What can cause this AA curve to shift? All right, so what can cause this to shift? Well, it'll shift to the right for one of the following three reasons. Now, this first one you'll notice is expansionary monetary policy. Now, we also can have an increase in the expected exchange rate and an increase in the British pound rate of interest. Now, what all these factors have in common is that each of these factors leads to a weaker dollar. All right, so that's what they have in common with each other, a weaker dollar. All right, so now let's see why. Now, of course, so yeah, any factor that causes the dollar to depreciate shifts this curve to the right. So any of the factors that causes the dollar to depreciate causes this to happen. And then, of course, that implies the opposite over here. The dollar appreciates. Aha, okay. So anyway, so we can summarize that here. So these are the ones that shifted to the left. These all these factors lead to a stronger dollar. Okay, so we can now rewrite this in the following way. And this way means a weaker dollar. Okay, now what we're going to do now, of course, is bring them together. Of course, you can see this coming a mile away. We're going to bring them together, and you can see that the interaction of the so-called goods market and money market, well, actually, we're calling this the assets market, jointly determines the equilibrium exchange rate and GDP, GNP. Now, what happens if one of the factors that we're holding constant changes? All right, so let's start by thinking about monetary policy. So remember, if we increase the money supply, the money supply rises, interest rates fall, and the dollar gets weaker. And as we've already seen, that means the AA curve shifts to the right. And we're going to see that the lower interest rates will stimulate GNP to rise, and we already know that the dollar will get weaker. So let's take a look at this. So again, we did say before that a weaker dollar shifts us to the right. So we have expansionary monetary policy. And you notice what's happened, E went up. The dollar got weaker, but at the same time, though, the economy got stronger. And that's exactly what we expect to happen. So the net effect is a weaker dollar, but higher GNP. All right, now obviously, if we have contractionary monetary policy, all of this will work in reverse. There'll be a leftward shift of the curve. We'll have a stronger dollar, but we'll have lower GNP. Okay, so let's take a look at that. Yes, okay, so everything works in reverse. We have contractionary monetary policy. And the result is that E goes down, which means we have a stronger dollar, but GNP also goes down. So you can see it does show on this graph that contractionary monetary policy strengthens the dollar but weakens the economy. And that's, of course, because exports are reduced. How about the DD curve? What causes that to shift around? Remember, there's several things that can cause that. We'd like to focus, though, on fiscal policy. All right, how did that work again? Let's see. Expansionary fiscal policy causes this curve to shift to the right. And along the way, GNP goes up, but E goes down because the dollar's gotten stronger and the economy has also gotten stronger. So this is the opposite of what happened with monetary. So we have expansionary fiscal policy. And as a result, you can see that E drops and Y goes up. So we end up with a stronger dollar and lower or weaker GNP. Now, by the way, we'll see these curves again in later chapters. So we're not just doing this because it's fun, but we will need these curves in later chapters when we start analyzing other factors besides just monetary and fiscal policy. We also want to be able to analyze the impact of monetary and fiscal policy under different exchange rate regimes, which we'll be looking at in maybe the next chapter. All right, so there's only one case left to consider, which of course is the reverse of what we're seeing here, and that would be a naturally enough contractionary fiscal policy. And that causes E to go up, Y to go down. So we kind of get the worst of both worlds. We have a weaker dollar and a weaker GNP or lower GNP. And so we've covered all four possibilities here. So the curves, really our job here was to set up the curves and understand how monetary and fiscal policy affect equilibrium, the equilibrium exchange rate and the equilibrium GNP, which we've done so that we can use this framework in later chapters to help understand more complex situations. So now that we understand how the curves work and how they move around, we can use these for other purposes. But for right now, I think this is quite sufficient. We don't want to dive into another new chapter here because it's very late. And also, we're coming up on Easter weekend. And we want to enjoy ourselves, don't we? So I think we'll stop it right here. And then when we get back next week, remember, first of all, to hand in your exams. But next week, we'll move on to the next chapter and continue with what we've been doing. All right. So unless there's any last minute questions, I will see you all next week.
Thank you. Have a good night.
Have a good night.
Thank you.
Bye.